if the client pushes for a certain aspect of a tax plan or wants to do a certain tax move, shall we say, that you should consider withdrawing from the engagement if it's something you don't agree with. Now, the problem that we see here is that withdrawing from engagement is not, or does not, how do I want to say this? It doesn't relieve you of the obligation of being responsible for this third-party arrangement that you don't agree with. So some clarification is going to be needed here in these areas. And now we have poll question number 2. Okay, I'll go ahead and move along. Hopefully everyone's had an opportunity to answer the question. This proposal was issued on February 18th, and the comment period ended on May 18th in 2023. The IESBA published the 46 comment letters that were received. NCCPAP, the National Association of State Board of Accountancy, the AICPA, and the Pennsylvania Institute of CPAs were the only US-based organizations with published comment letters. No other state societies apparently commented with regard to this proposal. There were also comment letters from many countries throughout the world: Thailand, Belgium, United Kingdom, Germany, India, Korea, Australia, Japan, Canada, Saudi Arabia, Zimbabwe, Uganda, Brazil, and South Africa. And there were also several international firms that responded. A couple of them would be KPMG and PricewaterhouseCoopers. NCCPAP's comment letter was authorized by Mark Stewart, our chair on Issues Committee and our past president. A thank you to Mark for doing this for us. He pointed out several areas that need further consideration with regard to the proposal. And that is, one of the areas is that the professional accountant will be considered responsible for the product or arrangement of a third party. I think we all agree that that is kind of a sticky point. He also pointed out that our existing ethics requirements are to refer clients if we do not have the expertise or cannot acquire the expertise to render the service to the client that's needed. This proposal would basically mean that even though we refer that out because we don't have the expertise, that the professional accountant will still be responsible for the work product of that third party. He also brought out the point that the proposal is biased against small firms that don't have in-house expertise where referrals are commonplace, which could result in your client seeking advice from other organizations or persons who may or may not be subject to rules and ethics that are currently in place here in the United States. This would be definitely an unwanted result. He also brought up the point that more guidance is needed on professional expertise and what is a referral. The professional expertise and referrals are not specifically defined in the proposal. He also brought up the point that a professional accountant will be responsible for all referrals made under current best practices. Now, we know that best practices here now is if a client asks for a referral, that you should give him or her 3 names. As an example, if they come to you say, well, we need an estate planning attorney, well, you give them 3 names. And so it's up to them to pick the one that they want to use. But however, it raises the question of whether the professional accountant is going to be responsible for the work product of any or all of those referrals. Also, more guidance is needed on what time period these provisions cover, because it's not stated in the proposal. The problem being that the professional accountant could be held responsible in perpetuity. Say that a client brings a tax plan to you and you provide advice on them, and the client says, or you refer a client to a third-party provider, XYZ lawyers, and the client waits 3 years down the road until he contacts XYZ lawyers. Now, your referral was based upon who was in that firm at the time. 3 years from now, you may not know anyone in that firm. The issue here is you could still be held responsible for the work product of that firm. It definitely is an issue. The AICPA issued a response letter that was about 14 pages, very detailed, very specific. There were 3 main things that came to light as I reviewed this letter, and that is the stand-back test we talked about. The AICPA is recommending removal of that stand-back test. They're also recommending the removal of the requirement to explain to management why a plan or arrangement failed the stand-back test. And that makes sense. If you're going to recommend the removal of the test, you shouldn't have to explain why it failed, why some plan or arrangement failed. And they also recommended the removal of the provision holding a referring professional accountant responsible for the plan or arrangement that is the work product of a third party. Now, there were many other issues that were addressed in this letter, and the letter was calling for clarification and or further guidance and or elimination of some of these issues. I'm going to read a few of these things coming out of the AICPA's letter so you get a sense or a feel from where the AICPA is coming. In one of the paragraphs, the AICPA says, we believe that if the professional accountants are required to apply the proposed standards in a manner that would comprise or jeopardize the protections to which a taxpayer is legally entitled, neither the taxpayer nor the public interest would be served, and the laws and regulations affecting the taxpayer could be undermined. They go on to further say that proposed provisions that trigger disclosure of information to a client or preparation of documentation would potentially provide tax authorities the ability to use the CPA's communications with the taxpayer against the taxpayer. Further says that these standards as proposed will likely cause taxpayers to seek advice from other tax service providers, many of whom, as noted above, may not be subject to any standards or ethical requirements. Professional accountants to contemplate alternative service entities that would not be subject to tax planning standards or similar of the IESBA or similar organizations. Really an unwanted result here, and the AICPA expressed concerns over that. They also said that they have concerns around the example related to establishing the identity of the ultimate beneficiaries of these tax plans or products. They recommend that the identity of these beneficiaries be limited to known and expected beneficiaries. Because we all understand that certain tax plans, when put into effect, can have impacts on related organizations or related individuals that you're unaware of at the time. The AICPA is concerned about this. They also go on to say that they recommend the phrase "shall take steps to disassociate from the engagement." In doing so, the accountant be eliminated from the requirement of these two sections. In other words, they're saying that if the professional accountant withdraws from the engagement, that they will not be held responsible for the tax plan or arrangement that the client may eventually adopt or go forward with. They also go out to specifically say that it is not appropriate to hold a PA who refers a client to a third-party provider of tax planning products or arrangements to the same standard as if they were creator of the tax plan product or arrangement, and therefore subject to all the provisions of the exposure draft. The ICPA also cites Circulation 230, which provides a good framework for the ethical conduct of tax practice. The AICPA was careful to say that they support the development of principle-based framework in this endeavor. The letter is signed by Brian Lynch, chair of the Professional Ethics Committee, and Jan Lewis, the chair of the Tax Executive Committee. A very well-written letter on that. The Pennsylvania Institute of CPA's comment letter. The Institute does not support Section 380 and 280 in its current form. Very strong letter. They say the only two areas that were talked about in the framework that should be considered here are threats to compliance with fundamental principles and regulated safeguards and compliance with tax laws and regulations. It's the opinion of the Institute that the remaining items that are brought about in Section 380 and 280 should be in a separate set of standards similar to the AICPA standards on tax services, and should be issued in a separate exposure draft and exposed to public comment. They go on to say that they are not in favor of the stand-back test. They bring up the point that such regulation could hurt the accounting pipeline. I think the answer or explanation of that is evident. And they cited one of the footnotes in the proposal that states a reason for these sections was a threat of European Union legislation. They also say that the term credible is a value judgment and it should be removed. The National Association of State Board of Accountancy issued in their comment letter, they state that more guidance is needed regarding credible basis. Pathway to address jurisdictional differences is needed. This goes to jurisdictional differences, obviously, that would be run into not only here in the United States at the state level, but also on an international level. The decision burden on the stand-back test should be placed on the client, not on the professional accountant, and that the professional accountant should not assume the responsibilities of a third-party provider if the professional accountant created the product or arrangement. This opinion is consistent throughout the letters of comment that I see. The holding of a professional accountant to be responsible for third-party work is uniformly, for lack of a better term, rejected by the comment letters. The decision burden on the stand-back test placed on the client, most comment letters are saying that that stand-back test is a problem anyway. So as the AICPA says, it should be removed. I have provided resource links for the publication and for the 4 letters of comment. If you go to the publication and scroll down, you will see links to all 46 of those letters of comments. I encourage you to read this. This is an important issue, and I'm sure the AICPA and NCCPAP, as well as the other affected organizations, will be following this to see what finally comes out in the final draft that's due out in December. Thank you for your attention. Neil?
Okay, so Frank, first of all, we did have, before we go into a couple of questions, one question I have right now is, when you were talking about the Pennsylvania Institute of CPAs, you referred to sections 380 and 280. Could you tell people what those are specifically?
Okay. As I indicated at the beginning of the presentation, Section 380 is the implementation of the standard frameworks in the exposure draft, and is applicable to accountants in public practice. And there's several items that are talked about in the proposal, and that is that it applies to tax planning and related services. Both 380 and 280 do. It says that any tax plan or related service must have credible basis in law. It also provides that you must exercise professional judgment, etc., in your assessment of this plan. And this is the stand-back test. It also talks about possible disclosure of tax benefits in a tax plan that you may have to do to jurisdictional bodies. It talks about uncertainties and how you're supposed to handle those with your client. It talks about how you're supposed to explain the basis of a tax plan with your client. And it talks about when you may have to withdraw from the engagement. And it also brings about the provision that makes professional accountants responsible for third-party work. And that's in both sections 380 and 280. Section 280 is applicable to CPAs in private practice.
Now, we did have a couple of questions that were posted, and just going to go over these because they've already been answered. So the first one is, when do these provisions become effective? And the response has been that there has an effective date has not been put forth yet, but looking at past frameworks, it's taken about 2 years from proposal to implementation. The AICPA has specifically requested an extended period of time to allow those countries without such frameworks the time they need to develop their own policies. And then the other question was, do these new rules apply only to US-based planning and transactions? And the answer there is that this applies to tax planning and tax services. In other words, this could have broader impacts than tax compliance, and this could also have an impact on financial planning services as well. Now, one thing I wanted to bring up, a question for you, Frank, is we talked about responsibility, that we could be responsible, that if we referred to you, that if we refer that somebody, we referred somebody out, that we would be held responsible. And as you pointed out, but what if the client delays in the referral that we make? So I refer, so somebody comes to me, I refer them to you, but they take their time in contacting you. It might not be a year or two. And then, of course, during that time, certain rules that may have changed, gone into effect. There may have been a change in their own circumstances from what I had discussed with my client previously. What impact would that delay on the client, by the client, have on us, if any?
According to the proposal, it's unclear. That, as Mark Stewart brought out, there's no timeline limit in this proposal. So theoretically, you could be responsible for this in perpetuity.
I know it's weird. just on a side note, I happened to be at my dentist recently, and she told me that if she referred me to somebody else, for example, root canal work, that even here under Florida law, she could be held responsible if something went wrong. But we do have a couple of other questions. So Irene Waxer asks, how are these new rules going to be monitored? Does this open up a potential for quote unquote peer review for tax services?
It's a good question. Don't know.
And then
I guess that's something for the AICPA.
And then one other question we had is, do these new rules apply only to US-based planning and transactions? And there was a response that this applies to tax planning and tax services, that this could have broader impact than tax compliance. Did I get that? Oh, should accountants be, no, we got through that. Should accountants, US accountants, be worried about international standards? And we actually have the responses that AICPA is part of IFAC, which enforces standards that ISBA puts forth. So therefore, yes, we would be subject to ISBA standards or IESBA standards.
Oh,
So,
that's correct.
oh, one last question. Does our professional liability insurance cover us for this?
I would recommend you call your insurer.
Good answer. Well, Frank, thank you very much. Everybody found that to be very informational. We have our third polling question. And while everybody is responding to that, we are going to move on to the second part of our presentation. Last month, NCCPAP had its spring meeting, and for the first time in 3 years, we were back in Washington. Visiting Capitol Hill, we had meetings with about a dozen congressional offices. To give us a report on that and other information regarding tax information, we now bring on Steve Mankowski, co-chair of the Tax Policy Committee. So, Steve.
Thank you, Neil. And just as I start off, yes, we had successful meetings down in Washington. We met with quite a number of staffers and even a few representatives while we were down there. And just for purposes of those on the call who may not have been down at that meeting, I did post a link to the agenda that we went down to Capitol Hill with. There were 6 separate items that we were addressing, and that information is available out on, again, as the link that I put into the chat. And if there's any questions or comments, you can certainly feel free to reach out to me after the meeting for further discussions. One of the other areas that just to talk about, just some post-tax season updates. According to the IRS, and I think many of us have a similar feeling, was that the 2023 filing season was actually almost a back to normal. And as I say that, it's not the new normal that we've had for the last several years during the COVID world, but actually kind of where we were before. We actually had the IRS answering phones again. We're getting more and more returns that are being processed quickly. There's less returns that are sitting in an inbox indefinitely. So from that standpoint, we really have been an improvement over the last few years. And is one of those reasons because returns are down? That's quite possible. As many of us have been aware, during the last few filing seasons, when the IRS had their economic stimulus payments, they applied to all taxpayers regardless of if they had a filing requirement. So in many cases, we were filing returns for retired taxpayers who maybe only have Social Security and really have had no need to file for a number of years. Well, now they needed to file in order to qualify to receive the economic stimulus. And I'm sure many of us have also had a number of returns that we filed for some of the high school and college students that maybe they wouldn't have filed in the past. but wanted to, for whatever reasons, the parents were trying to get them stimulus money. It's quite possible that the returns were down because of that. It's also possible that there's a number of those returns that are also sitting out on extension because of the whole tax season compression that we all faced during the beginning of the year. The IRS is telling us that they had 963,000 unprocessed returns, and these are returns that are not in any of the reject, or they're not rejected, not sitting in any of the error categories that we've had in the past, and that they're anticipating July 1st as a date that they'll be able to get many of these returns finalized, especially if it's returns that were fully paid. And as I state that, a number of us probably have been getting a number of notices that our clients are sending over. It seems that with the IRS sending out notices again, that they've now started sending out notices of underpayment penalties for a number of taxpayers, even when they hadn't received those notices during COVID or even pre-COVID. I know that I've gotten a number of them in my practice, and I'm sure that many people have also, if I'm getting them, I'm sure a lot of the rest of you are getting them as well. In the past, you've heard me talk about what the IRS is referring to as fixers. That's basically a system that they put into place last year that was fixing returns that fell out after being accepted into the error resolution system. It basically is allowing those returns to really be fixed almost automatically. And many of the returns were just needing some additional clarification. A number of the reasons may also be that there weren't the economic stimulus payments, nor were there the advanced child tax credits that needed to be reconciled, that often were what were falling into those categories. There's also a number of returns where they're sending out where there's correspondence that are needed, returns that were rejected from those standpoints, 831,000 personal returns, 321,000 business returns. These are cases where maybe data that was sent in needed additional information. The IRS has gotten better with rejecting cases where the taxpayer went to the marketplace and didn't include Form 8962 for the reconciliation of the advanced tax credits. What they're finding is that most of them are simply workable after the taxpayer responds. However, the conundrum that the IRS gets is what they do after that, after the period if the taxpayer doesn't respond. Generally, they're allowing a 45 to 60-day window for which to respond. And what they're finding is that if they're not getting response, then they're simply disallowing those items after that 45 to 60-day window. And there's, as you can see, there's a large number of returns that fall into those categories. And then, of course, we get the unpostable returns that have whatever issues that are preventing them from posting. And many of them, from a business standpoint, relate to S Corp returns, where the S Corp form, the election form 2553, hasn't been processed yet. Maybe it was submitted in with the return, maybe it was paper filed, but these are returns that until that the election gets processed, there's nothing that the IRS can do in order to process those returns. One area that's been discussed within the National Public Liaison meetings, or NPL meetings, a lot over the last probably year and a half, and certainly it really picked up during the COVID period, is digitization. Something we really normally don't think of the IRS doing, but it's certainly one, as my staff accountants are chiming in and agreeing. It's really a means for the IRS to really try to be more efficient and And it's gotten to a point that although it's extended to 2030, when the IRS submits the returns to the Federal Record Center, they're going to have to start sending forms, sending everything through electronically. So coming up with a mechanism to digitize the tax returns that are being filed is only going to help. And I guess the byproduct is it will also help as far as returns when they get selected for audit. You're not going to go in and meet with the agent, and they're going to be sitting there with a thick file with tax returns. Everything will be electronic. Hopefully, it'll be much more streamlined, and hopefully they'll have all the data that's necessary. As a starting point, the IRS is talking 1040 plus 10. And what that is, there's just 10 specific attachments that they're using as a starting point to include with returns. And they're constantly adding more and more of the various attachments into that. So keeping in mind with the different attachments, it could be something as simple as W-2s. It could be other schedules that are associated with returns. And at some point, and hopefully the very near future, but you never know with the IRS, they're looking to add in the 941s and the employment returns into that process to really just make the digitization that much more effective. And with that, I believe, Neil, we're coming to polling question number 4.
Yes, we are.
So while everyone's answering and going through the polling question, I'm just going to continue in on my presentation, but please try to answer those as quickly as possible to make sure that you get credit for the presentation. Information returns intake systems update. That's quite a bit of a mouthful. And anyone who's familiar with the IRS and their dealings knows that the IRS likes their acronyms. In this case, this is often referred to as IRIS, I-R-I-S. And it's really going to be a system that for tax preparers as well as taxpayers, where they can manually enter in their 1099 data. The data itself gets retained from year to year, as preparers will be able to upload CSV files, download and print the 1099s to send out to the recipients, e-file and correct the 1099s, and file automatic extensions. I know that the 1099 software that I've been using over the last few years, and in speaking with the IRS, they're working with the software companies to be able to implement this and interface in with the different software programs. They're not looking to replace those, but it's certainly if someone is looking to step up how they're doing things, this is certainly a means with which they'll be able to do this. There's 2 publications that are out now, or at least one's out. 5719's already been published. 5718 is coming soon. And that's really giving more detail and more depth into what the IRS is doing with IRIS and how to use it and how it can be more meaningful for the taxpayers and preparers. It's going to be effective for the 2024 filing season. So that'll be for starting after January 1st of this year. There's 10 to 15 forms currently from the fire system. And the ultimate goal of IRIS is to replace the fire system. However, they're not planning on disabling fire system in the near future. They just basically want IRIS to be a modernized version of the fire system. I've used fire over the last few years. It really works pretty seamlessly, and it does work with my existing tax software. So I'm kind of anticipating that there really won't be much of a change that we'll be seeing on our end. It's going to be more of the back ends. And hopefully when we actually have to go into the system, their goal is that the user interface or UIs and the customer service portals will be better than what currently exists within the framework for the fire system. To get more specific information on IRS, there is a link that the IRS has on their website that really can provide you a lot more information than what we're covering briefly here during this presentation. IRS direct file, I'm going to really cover this very quickly. It's one that really doesn't affect us, or hopefully won't affect us, but it's more from an informational standpoint. So I'll cover this really quite quickly. It's a byproduct of the Inflation Reduction Act, and it's one where part of the bill asked for the IRS to explore the feasibility of this direct file program. The IRS and their definitions of what their role is to administer tax law and to assist the taxpayers to follow the law. They view this program in the same scope. When Free File first came out, it wasn't as widely used as it was anticipated. They're really looking at direct file almost to fall into the same category, because in their minds, they think they don't want to have too much of a unity with the preparation and the processing. It kind of oversteps a lot of their bounds. But they're just looking at this to be just another option that taxpayers will have to get their tax returns filed annually. They're not removing any of the existing categories. Paid preparers are still going to exist, as will over-the-counter software, and they're also anticipating Free File to continue in its current state. The point that they also made is that many of the states still have state tax returns that fall into play as well. So even if you're using this program for your federal return, you're still going to have to go through and file a state return. E-file updates for businesses. This specifically relates to us, or it could relate to us depending on how you run your practice and such with filing of tax returns. Ultimately, their goal is to increase the electronic filing of business tax returns. Again, this is effective for periods after 12/31/23, which means that it'll be for the 2025 filing season. What's going into effect is the new filing threshold is down to 10 returns during any given calendar year for business returns. They're aggregating all return types. It's not going to be 10 S Corps or 10 partnerships or 10 C Corps. As soon as you reach 10 business returns, you'll fall under the threshold for e-filing. The one caveat that they have is, even if you're under that threshold, if you're a partnership or doing a return for a partnership that has over 100 partners, that return must be e-filed going forward when that program starts. At this point, that 10 return threshold is not including the employment tax returns. Again, for corporates and S Corps, the 10 return types, as previously stated, is going to be in effect, but they are removing the $10 million asset rule. So in the past, that was one that would throw in the necessity to e-file a return. Now there's no asset limitations or any asset thresholds. If you, from a correction standpoint within business e-file, if the original, and again, this is under the new rules, if you've e-filed a return, your amended return must be e-filed. And the one that's a little strange in the mix is if you paper file the return, if you're permitted to paper file and you paper filed it, you must file the correction on paper. It seems to me that you'd think that the IRS, if they want to really boost up e-filing, I mean, it's one where you may have hit the threshold and then it may have been under the 10 return threshold, but then during the season you filed your 11th return. Then if you have to amend that return, you're still going to have to amend that return on paper. Seems a little strange given the IRS's rules and what they're looking at, the purpose being, but that's the IRS. If somebody can figure out how they work and how they think, please let me know, because for all the dealings that I have, and as Neil would agree, it's pretty in depth with the people that we deal with. I can't figure them out, and I don't know if anybody can. And at that point, we can open up the floor for any questions. I'll pass it back to you, Neil.
Okay, we do have a few questions for you. Now, first of all, actually, the first one is a comment that they're getting many more erroneous notices being issued by the IRS. And
Erroneous in what standpoint?
they just said erroneous note, I guess notices in error. I know I've gotten a few myself, nothing major, but Wayne, could you be a
That's
little
one
more,
that
this is from Wayne Landau. If you could answer a little more on that when you say erroneous notices, Wayne, if you please. But we have two other questions about here. What about when the taxpayer prefers to file on paper? Because there is Form 8948.
I do believe that they will be having to submit that form. That would still be, it's still been in effect for individual returns that fall, when you fall under that category. Every now and then I see one on a new return, and I'm anticipating that the same will be in effect for the business returns. The number of clients that actually request the return be filed on paper is, I mean, I did a large number of returns this year, and nobody specifically requested the return be paper filed. I know that once I had the ability to start electronically filing 20 plus years ago, I never really even consider an option of paper filing unless somebody specifically asks, which is very rare.
Speaking for myself, I tell all new clients I am required to e-file tax returns. The only time I
Yes.
don't is when they're a victim of identity theft. And then someone else
Actually, I
asked,
had a unique one this year where a father and son, both with the same name. The son had gone to the marketplace for a month, and the father's return continued to reject, stating that he needed an 8962 even after the kid's return was filed. So that was one that needed to be paper filed, and they received a notice looking for additional information. So just wonderful that that return was filed probably 5 months ago and still sitting in still haven't gotten their refunds back. Next question, Neil.
another one asks, is the 10 tax return rule only for paid preparers? What if you are doing family members that you're doing gratis?
I believe that is falling under, well, if they're doing 10 corporate returns gratis for family members, but I think it's if it's being submitted under your EFIN, that the clock is, or the count is going to be counting any of those returns that may be set as to be a self-prepared. I'd be surprised if they didn't count those, because their easier tracking is going to be based upon EFINs.
Okay. While we have a couple of minutes, just very briefly, we can talk about Washington for a moment, because we did have polling question number 5 is on the line. So everybody take a moment, and while they're responding to that, I know that we had a dozen meetings on the Hill with both sides of the aisle, Republicans and Democrats. And as I recall from when we had our post-Hill meeting, that in general, that both we and the issues we brought were well received.
Correct. One of the issues that out of all of these that really can be affecting us is dealing with our support of House Resolution 190. And what that refers to is one of my favorite topics for the last year and a half, the Form 1099-K and the rules that were delayed in December that were back in effect come January 1st, which is the $600 revenue threshold with no number of transactions. It's really, that's one bill that's gotten a lot of bipartisan support to increase the thresholds back up. And it's one where, yes, if somebody makes money on selling something, they should have tax liability related to it. But the amount of work that's currently required to adhere to the law as it's going to be written with lack of aggregation. You take someone who maybe has an estate sale, they sell 20, 30, 40 items, they're going to be over the $600 threshold. Each item, if it's sold to different people, would have to be reported. If it's figuring that they didn't make money on it, they'd get a 1099-K potentially, and then the income gets reported. Each item is specified separately on Schedule 1, Part 1, and the basis, which can exceed the revenue on Part 2 of Schedule 1. So it's really could be quite voluminous, and especially if you factor in that we already have tax season compression, that this is one that's even going to be exacerbating that compression, especially if you get someone who maybe has or sells tickets to sporting events or concerts and such, that they sell a couple tickets, they can easily be well over the $600 threshold, and the reporting for that can be quite voluminous. The ability to get the data is probably equally as difficult, because if they make money, that has to go on the Schedule D. And if they don't make money, you can still put it on D if you want, but from my understanding, no aggregation. So unlike what we do with brokers and put, here's the totals, I don't believe that that's going to fly in this case.
Okay. All right, thank you, Steve. Thank you. I did think I saw somewhere that they were talking about raising the threshold or proposing legislation that would raise it back up to, well, not up to 20, but maybe to 10,000.
Well, the existing bill that's out there is resetting the transaction limit as well as the dollar limits. So I haven't heard of any other bill being sponsored and presented at this point, other than HR 190.
Okay.
So at this point, that's really what I would be basing off of, is what the existing bills are. But until something gets passed, as we're speaking with any clients, we need to make them aware that if they're doing any selling through Venmo, PayPal, StubHubs, that they may be getting a Form 1099-K at the end of the year, and what you're going to need to get from them in order to be able to accurately file their tax return at the end of the year. Better that you hit them sooner in the year and turn around and say, hey, that got pushed off or the rules changed, than wait till the end of the year and then have them not be able to get all of the data in a timely fashion to us as the preparers. Better be proactive on that one.
Yes. All right, we'll see. Thank you very much. So we are now
You're quite welcome.
Okay, so moving on to our last presenter for today. This is something that is based on legislation that was passed a few years ago, but is going into effect now. It's rules on beneficial ownership information. Now, For those of us who file the FBARs, we know that goes with filed separately with FinCEN. This is something that would also have to be filed with FinCEN. And to talk about it, we are very pleased to welcome Melanie Lauritsen. She is the AICPA Director on Tax Practice and Ethics. Both Steve and I know her very well from MPL meetings over the years. Melanie has been one of the forces in the various letters in recent years that AICPA, NCCPAP, and a dozen or so other national organizations representing accountants and CPAs have presented to Congress. So without any delay, Melanie Lauritsen. Melanie?
Thank you, Neil. And I really do appreciate the time to be able to speak with this group. So beneficial ownership of information, you know, its name doesn't really tell you what it is, but yet it does. And one of the things that drives me up the wall is it's a big deal. It's going to impact a lot of people. It has a huge and broad scope, but what is it really? So the way I think about it, it's an anti-money laundering initiative. And what they're trying to do is if you have a business that's owned by another business, that's owned by another business, right? We're talking shell companies. They want to know who the ultimate beneficiary is of the ownership of this business. Hence, it's called beneficial ownership of information. So it's meant to be transparency throughout the different layers to be able to know who is the owner and who's really benefiting this. So what does this mean? And how does this impact our taxpayers and us as we help the taxpayers navigate through this law? So pretty much anybody, an entity, and to be very clear, an entity that has set up legal formation through the state treasurer has to file this return. Okay, there are some exceptions, but the exceptions are in the reverse, right? Because most often when you hear exceptions, it's the small businesses that get the exceptions. In this case, that's not the case. So if you're a large business that has over 20 people and also has revenues of over $5 million, there's a few other things too, but in general, you would be exempt. Otherwise, you're not exempt. Now, there are 23 exemptions, but those 23 exemptions, the likelihood that you qualify for them or your clients qualify is not that large because those 23 exemptions, it's because they're already heavily regulated by the federal government or the state government, right? So for example, an exemption might be a nonprofit, but they have their own reporting requirements already set in place. So again, there aren't a lot of exemptions out there that would be applicable to the majority of our clients. Now, if you had a business that already existed before January 1st of 2024, right? So it's prior, you have a full year to file this beneficial ownership of information form, which really, like FBAR, we're expecting it to be online through FinCEN. So you have a full year. The real problem comes in if you are a new entity that is created after January 1st, or if there was any change in the ownership. So for example, think of a small practice that might have a couple of partners. One of the partners has moved, right? Their home address has now changed. So therefore, piece of information has now changed on the beneficial ownership. And therefore, you now have 30 days to file the beneficial ownership of information return, which makes it really, really tight. And we've actually had conversations with FinCEN about this. Well, let me get to the penalties first. So the penalties for willfully not filing, and we'll discuss willfully in a second. For willfully not filing the form, the penalty is on the taxpayer, not on the tax preparer, right? And it can run up to $10,000, so $500 a day, up to $10,000, and up to 2 years in prison, right? So the penalties are actually really steep, and it goes into willfully not filing. So in my conversations with FinCEN, very recent conversations with FinCEN, you know, when a business is moving or a business owner is moving, the last thing that they're really concerned about is about getting these forms filed, right? They're moving themselves, like if I happen to be a business owner, I happen to have children, right? And I move locations, I'm more concerned about making sure my credit cards are updated, I'm transferring phones, I'm transferring the mail, I'm making sure my kids are registered at school. Again, the last thing I'm worried about is making sure this form gets filed. And that also ties in with the awareness. So because of that, you could accidentally be non-compliant. So in speaking with FinCEN, I think it's interesting because they'll push back and they'll say, well, you're not the average person we're trying to nail down for this. We're, looking for those anti-money laundering initiatives. And I hear that, but at the same time, the law is the law, right? The law is very clear. You have 30 days, right? And when I spoke with FinCEN, they're like, we wouldn't be upset if you filed in 45 days. Again, the law is the law. You have 30 days to file, not 45, and you need to be compliant. So then it becomes into this, what is willfully non-compliant, right? And so I brought this up with FinCEN too, in that, again, they're not coming after the small businesses. They're not looking, according to them, the cleaning lady that has her business who is struggling to make ends meet and put food on the table, right? And has no awareness of this filing requirement. They're not looking to pursue someone like that. But how many times have we worked with the IRS in that, the intention of who they're trying to pursue is correct and it's up here, right? And we've talked to executives who their intention is like, we're not going to issue notices to these types of people. And yet as it trickles down, all of a sudden people start getting notices because they didn't file in 30 days, right? They may have filed in 35 days. And they start to get notices. So again, the intention is great, but the law is the law and it's the law. And there's no changing the law. So we've had that conversation with FinCEN, and they think it's a curious and interesting approach what we think of that. And we think about, for example, I'm going to use an example. Hopefully it's not offensive, but let's pretend, on the radar for FinCEN is a Russian group that is trafficking, say, people. And let's say, again, I'm that cleaning business where I hire Russian girls because let's say I'm Russian and therefore I'm bringing them in, right? And hopefully they get somewhat established and they moved on to other careers, right? So I could look like I'm moving quite a few people through my business and I'm just a legitimate business owner. I'm not doing anything with money laundering, but let's say there's a red flag. And again, I don't file the form within 30 days, 60 days, 90 days. From FinCEN's perspective, I could look willfully that I'm not purposefully not trying to file the forms. So again, I really hate that this word is up for discretion. There's no definition of willfulness. So it becomes a bit of an issue.
Melanie?
So, yes, Neil.
I'm going to interrupt you because I know you said we could ask questions.
Absolutely.
So what makes an owner a beneficial owner? Is there a certain percentage they have to have an ownership of?
Yes, good question. So right off the books, they say if you own 25% or more, right, you're a beneficial owner. But it gets tricky in that if I have authority over decisions for the business, then I too could be considered a beneficial owner, right? So they also pull in like these senior executives of a business. They're automatically considered beneficial owner, even though they don't have any ownership stake in it, but they can make decisions on behalf of the business. They're considered beneficial owners. But then it becomes a little bit gray in other scenarios as to who exactly is a beneficial owner. Most likely, in the majority of cases, it will be straightforward and it will be just 25% or more.
But if somebody, for example, if you had someone acting like as a controller or office manager with have a certain amount of influence,
correct,
they would have to be included in such a report.
Right. And so when you start getting into these, and I'll also tie this around too. So you may have owners, right? Let's say you have 4 owners, each one owning 25%, and then you have a controller, right? And then you have a couple of other people. So let's say you have 8 people who have to be essentially reported as beneficial owners on this form. And you look at this in the big picture. FinCEN also said to me, oh, but you probably won't be filing every 30 days, right? Because I told them this becomes a monthly filing requirement. It's really burdensome, right? You have 30 days to file. So you have to keep up, say, with those 8 people in my example of making sure there hasn't been a change in any of their circumstances. But when you get into the larger amounts of people with their hands into this, yeah, it becomes a bit of an issue. There is something called the FinCEN identifier, which we encourage professionals to have their clients sign up for the FinCEN identifier. And that does put the burden of the 30-day requirement on the taxpayer versus us as the preparers. However, that's like, it could be a slippery slope because ultimately our clients are coming to us because they don't want to deal with this, right? I mean, think about all the tax complaints that we do, or the FBAR. Do they really want to be on the hook and responsible for this? Not really. They're coming to us and pointing the finger at us to keep them in line so that they'll be compliant. So keep that in mind too.
So after the initial filing, just,
Yeah.
it's not, this is not something that's annual. It's only when there is a change after the initial.
Correct. So the initial filing, if you were in existence, you have a year. Otherwise, you have 30 days, right? January 1st, 2024 is a cutoff. But every time there's a change. So if a partner retires, you'll bring in a new partner into the practice. Maybe there's an inheritance. The controller changes, he leaves, you hire somebody new, all sorts of different things that can change.
And for the new businesses that
Yes.
start next year,
Yes.
when does the 30-day clock start?
Good question. So it's once the state has recognized you as that entity. So really, there's 2 ways. And if you look at the regs, which the regs are obnoxiously long too, close to 100 pages, it does detail it and does give you an example. So with states, there's 2 ways to be able to tell. Is usually they send you the letter of confirmation. And once you get that letter of confirmation, that's when the clock starts ticking. The alternative for some other states, they don't issue letters, but they do public notices. And therefore, it is on the taxpayer's responsibilities to be keeping up as to when they make that public notice that your entity was formed. And that's when the clock starts ticking. You have 30 days.
Okay.
Okay, so a couple of the other things to be aware of. So we've talked about the penalties, they're kind of ugly, but for professionals, there is controversy associated with non-attorneys providing advice on this form. So what does that mean? So take beneficial owner. Who's a beneficial owner, right? Sometimes we may need to provide advice as to who, maybe you don't own that 25%, but like the controller, who has that authority. And providing that advice could be considered potentially unauthorized practice of law, legal advice, right? Now, let me be clear. We have spoken with the ABA, and unauthorized practice of law is determined at the state level. Let's start with that. Right. We've spoken with the American Bar Association because there's the bankers, but we're talking the American Bar Association. We've spoken with them, and their knee-jerk reaction is, yeah, no, we don't even want to touch this, because the likelihood that they have all this information for these businesses is very slim. And so they're going to prefer that we, who prepare the tax return, has that information and continue and file and support with this filing. However, we did ask them to speak with all their tax sections at the state level, and they have, but they won't put anything in writing saying that it is not unauthorized practice of law. So we encourage members to reach out to their state regulators, to reach out to counsel if need be, and also to reach out to their insurance carriers. Now, we do know there is an insurance carrier in California who has come out and said it's considered unauthorized practice of law. But we also know another insurance carrier has come out and said that, no, they're actually going to provide engagement letters, and you should have a separate engagement letter for this if you decide to move forward. Again, we can't tell you it's unauthorized practice of law. We can give you guidance as to how to make that decision. We did bring this up with FinCEN, And FinCEN thought it was very interesting, that perspective, that has arisen, that it could be considered an unauthorized practice of law. From FinCEN's perspective, that was not the intention. The intention is for practitioners and tax professionals to be able to support this.
Should we also be contacting our various state societies? For their-
Absolutely, because it's done at the state level. So we are raising awareness. One quick thing too, this law is supposedly in its first year, it should impact 32.6 million people. And every year thereafter, there should be between 5 to 6 million filings on this. So because it is such a large, broad reaching scope of people who could be impacted, the AICPA pulled together a coalition. NCCPAP is one of them, and they have been one of the biggest supporters. And we are so grateful for NCCPAP for always wanting to raise the alarms when needed. So what we did is we created a resource that is client facing. It's a taxpayer facing document, right? And NCCPAP has their version of this. It's a different color, but essentially the same document. So what does it tell the client? Keep in mind, they come to us for the big things. So they're not going to care who a beneficial owner is or company applicant. What they do care is, do I need to file? When do I need to file? What information do I need to provide? And what are my penalties, right? Because once you realize what the penalties are, it becomes a little bit more, oh yeah, gee, I really do need to file. So we do have this client-facing tool that is meant for us to share with the clients. Additionally, we have one we call FAQ highlights, which is for the tax professional. This goes into a little bit more information as to who the beneficial owner is, who the company applicant is, what you need to be aware of, which is like unauthorized practice of law and other considerations, Neil, like you said, at the state level to try to bring it up at different levels to cover yourself if you're going to move forward with this. And then finally, we do have a copy. What we did is the Federal Register, they put out the questions that would potentially be asked. I don't know about you guys, but I don't know that our clients read the Federal Register. So what we did is we pulled all those questions and we kind of slapped it together in a chart. And so you begin to see it's not one or two questions. It adds up to something like 51 questions and a lot of little subparts for this. So it's a little bit more detailed than what we would like. Like I said, there are stiff penalties associated with this, and awareness really is the key in keeping the members on track. Neil, any other questions?
Oh yeah, got a couple for you. So first of all,
Sure.
one person writes, isn't this redundant information that tax returns and state governments have already?
So not all of them, and they're not connected. So in theory, yes, they should be talking, but not in a central database.
And if does a business need to file a report if they are exempt?
No, they don't. If they are exempt, they do not. There is one caveat though, and you do need to be careful. So let's say I am an exempt organization, but I'm owned by a non-exempt organization, right? So you do need to be careful with that. And depending on the organization, how it works out, you may or may not have a filing requirement, but for the most part, no.
Okay. Somebody asked if we can provide a link to that resource. I think we can.
Yes. So if you look on, sorry. So if you look at this one, where see how at the bottom last bullet says Beneficial Ownership Information Reporting Resource Center, that has all the links to all these resources and also additional things. So there's a podcast where it discusses beneficial ownership of information. There's also articles to give you a more general, deeper dive, but not having to read, 100 pages of regs. Other things you should be aware of, there in total should be 3 regs. The first one has been proposed and approved and finalized. The second one has been proposed and is open for, it was open for comments, and it has to do with privacy data of who has access to this type of information. And then the third reg, we don't know. That should be coming out, hopefully soon, because, it kicks in January.
Okay, so where do we find, what are the rules written for the BFO provisions? Where do we find them? I think we just answered that.
Right.
Okay, what about disregarded entities, single member LLCs, for example?
you know, I get the questions like, what about this? What about this? And do they, it really comes down to if you filed with the state treasurer, you will have that reporting requirement unless you're exempt.
Okay, somebody asked if these resources are behind the AICPA paywall.
So not all of them. There's only one right now that is locked in. And the reason, and the coalition kicked in, we believe awareness is key. We believe we need to educate as many people. We believe we're on the front line, that taxpayers are going to turn to us for help with this. And if we're not prepared, it doesn't help anybody. So the resources that I showed you just now, they're open, they're free, they're meant for you to use as you can. Like I said, the podcast, articles, other things, webcasts, all those types of things, they are open and unlocked.
Okay, next one, well, this is more of a comment, is our clients turn to us to keep them in compliance with tax regulations. Why is FinCEN forcing us to act as quote unquote lawyers, requiring us to protect our client from this new series of requirements? Our small business clients do not wish to deal with a lawyer as well. Besides, yes, this is redundant, just like the information being requested by the Census Bureau.
Yeah. So in a nutshell, they see this as being a key stepping stone in order to combat fraud. And this what brings up the whole EU ruling, Neil. So the rest of the world is more advanced, and in going through with these laws and implementing them, the rest of the world also is a little bit more transparent with this type of information. So the US, in comparison, seems to be a little bit behind and not as transparent. So this is the first step that we're moving forward while the rest of the world has done it. Now, in EU, there is a case, it just came out, I want to say Friday, in which there was an owner who had had a few shady dealings, and his information was put out because they actually have it in a public database. The United States is not planning on having a public database, but people can access it by request, and it's usually governments and like the state governments, IRS, those kind of entities, or anybody who has financial, like banks might be able to access this, right? So it's not meant to be public. But anyhow, in the EU, it is public information. And one of the persons who went through this was penalized, whatnot. They came forward and they said that it is actually really harmful to have his information on these public databases, because he's now become the target of like potential kidnappings, ransom, threats, whatever. And the courts came back and they agreed with him, saying that this information was a violation of privacy. So keep in mind, it's slightly different than what the US has, but it still gives people legs to be able to come forward with this type of information and sue, and saying that it is a violation of their privacy. So we're going to wait and see how that pans out. But this law, this requirement as it stands, it's part of the Corporate Transparency Act. It's moving forward, and it is kicking forward on January 1st.
Now, an actual form has not been issued yet.
Correct. The only thing we've seen are the questions in the Federal Register, which we've taken and created that form, and that chart is actually available on that link. You can click on it and you have access to it, so you can see what's being asked.
And then, okay, two more, and then we're
Sure.
pretty much done. What is the purpose of centralizing this info with federal and state returns already report this and the government already has access?
So it reports some of the information, right? Not all of the information. So business owners should be able to file, but it doesn't necessarily show who has that influence. And there is some of that information that is accessible. So it begins to become a tricky balance of it. And then there's a whole communication of who has access to the information.
Okay, the last question we have, well, it's a comment, is this is going to take a lot of time to complete the forms. How are we going to bill the clients for this report and the fact gathering?
Yeah, so that's a popular question. So let me let me start by saying that when FinCEN has come out and they propose some times of how long it should take to be able to gather this information, right? You know how like the 1040 has like the estimated times to prepare the return and all that? Okay, they did the same thing for this form that doesn't exist, which most likely will be online, to your earlier point. So essentially, they don't think it's going to require a lot of time. We believe that's wrong. We believe they've underestimated it pretty dramatically, and we believe it will take time to gather the information. It's more so like pulling those teeth to gather that information, because as you guys know, when you work with your clients, they don't call you every single time there's a change or an event, right? You've got to pursue them every single time. So it becomes a balance of how can we do this? And it's critical that if you are going to take this on, that you have an engagement letter so that there's a clear understanding of what you will be taking on for them. So if that means you will be checking with them monthly, it is something that you need to budget into your time and into the budget that you have with that client. It's a difficult question to answer, but yes.
Oh, and somebody did ask, this will be, since this is FinCEN, it will be strictly electronic, correct?
In theory, that is the thinking, like the FBAR.
Steve Mankowski, you had a question for Melanie? Steve, are you there?
Your microphone isn't.
Is that better?
There you
Yes.
go.
Gotcha. In light of where we're talking about the changes, if there's a change that they're going to have that 30-day window, are we anticipating that if someone changes, so if the CFO moves,
Yep.
are we anticipating having to answer all 50 questions again, or will the follow-up be
abbreviated version?
more streamlined as to, okay, what data has actually changed? I know from the initial filing, it's based on whatever the information is when we do our filing. So if anybody moves during the year or anything changes, whenever we file it, it's the most accurate. But it would seem kind of convoluted to go through and answer 50 plus questions just to say that Neil moved, or that we've realized that an address that we had for one of the people wasn't correct, and we're correcting it as quickly as possible. Do we know that, or is school still out on that one?
We don't
Thank you.
know that. We don't. And it's a good question, Steve. There's a lot that we still don't know. And like I said in my conversation with FinCEN, so I gave them a gentle spanking, pretty much because they're not raising awareness and they need to raise awareness. This is their issue, right? But that was also another topic of conversation. Like, we need to know how you're implementing this. How are you moving this forward? And what does that mean for those, when those 30-day window period? So we don't know is the answer, Steve. And that is something that we will keep pushing FinCEN. What I can tell you is, as we get more information and as we continue the conversations with FinCEN, we will be posting to that landing page that we have there. Steve and Neil, both of you are amazingly good at keeping in contact with me. You're part of the coalition. So as we see these things change, I will be more than happy to keep you in the loop so that you can raise awareness with your members.
We do have one last question, I think. Could the company, and this I think is benefit for all of us, is could the company CPA be considered a beneficial owner?
Ooh, so you're talking, since we're giving advice, right? Like, you could be planning advice into the business. Potentially. I mean, that's a really good question. That's the first time I got that question. I don't know. We'd have to look into it, but potentially, like, if you're having such a huge influence and depending on how much you're involved into the daily dealings also, it could be potentially, yes. That's something that I can bring up with FinCEN for sure. Good question.
That's a very good question, because our clients talk to us all the time is,
Yep.
For example, should I buy or lease equipment? Simple question. No, that can have a very big impact on other decisions that they make down the
Yeah.
line.
Yeah.
And Melanie, that question came up Friday when I presented to Neil's chapter. And
Okay.
it was one where the CPA was a bookkeeper for the company. And it's kind of, whether it's bookkeeper, acting, outsourced, CFO, whatever term you want to
Right.
apply. And my comment to her, and you can certainly scold me if necessary, was when in doubt, they're better to put down that they could be a beneficial owner. I'd rather, and better to err on the side of providing the information than to find out after that you didn't and be subject to penalty.
So Steve, I just don't know the answer, but I will email Vincent. I'm taking notes right now on it because it's a really good question. It's a really good question, which would have more implications on us than what was expected, because we talk about the penalties being on the taxpayer, but yet if we're considered one of the beneficial owners, that means penalties on us. So really good question. Yeah. Okay. I'll be taking that back.
One person did ask if we could repeat the following threshold, and is it per company or cumulative? It is per company. And right now, a beneficial owner is 25% ownership interest or more, or a non-owner who has significant influence on how the company operates. So, for example, a company controller or an office manager who has a lot of pull.
Right. You got it.
Okay. Do we have anything else? Oh, one second. Okay, so for the FinCEN fund, we answered that. How many more sensitive questions will the reply be? I'm not sure what you mean by that when you say sensitive questions. That's a very good question, but we're not getting specific answers that we need to know to determine. I'm sorry, Evan, you're going to have to be a little more specific on your comments and questions. And then someone made a comment that once they create a filing, FinCEN will, saying that FinCEN will make this an annual, but according, so in that response, and for what Melanie has told us, according to this, it will only be the initial filing, and then whenever there is a major change. So for example, if you bring your child and give them 50% into the business and give them an ownership stake, you have to report that. If you move, if your office moves, you have 30 days to inform FinCEN of those changes. And as Steve just asked the question, is it just one thing, or do you have to start and redo everything from scratch again, which Melanie has made notes and is going to find out. And once she knows, she will let us know, Steve and I, and we will let everybody else know.
Right. And part of the reason also why it's supposedly meant, like, as long as there's no change, it's a one-time filing, because they're expecting 32.5 million filings or 0.6 million filings in the first year, and then 5 to 6, which means every year thereafter, which talks towards the movings, the new creations. So it's not, in theory, a yearly filing,
Right.
but it's more like a monthly reporting requirement.
Okay, we're just out of time, but 3 last comments. Beneficial owner, if the CPA is considered, would that would also apply to a lawyer or a management consultant? Someone says, I do not understand how we can be deemed a beneficial owner, quote unquote, but again, it's having the influence in those cases. And then maybe the act, and then someone made the comment, maybe the act should be known as the beneficial party rule. So, Melanie, I think we've given you a few things to have further conversations with FinCEN about, because, you know, their intentions may be good in determining fraud, in going after money laundering and drugs and anything else that is of a shall we say, dubious nature. But sometimes it's not as thought out as well, and it can suck in more people than it's intended to.
Right.
So, Melanie, thank you very, very much.
Thank you for
this
having
information. Thank you very much for the conversation. We really appreciate your taking the time and sharing this with all of us. So on behalf of Melanie, Steve, and Frank, thank you all for attending. Again, the PowerPoint is available on the NCCPAP website. You will be informed as to when this will be available for you to download and listen to at your convenience. So on behalf of everybody, this is Neil Fishman saying thank you for attending the 7th edition of NCCPAP Now. Have a good rest of the tax season, the rest of the tax season being until at least October 15th.